And welcome to ETF Edge, your go-to place for exchange-traded funds. I'm your host, Bob Pisani. The ETF industry is big, and it is getting bigger. Over $500 billion in inflows have occurred in the first 7 months of this year, and there's a shot at $1 trillion for the full year. That would be an all-time record. The ETF industry is now approaching $10 trillion in assets under management just in the United States alone. So what's going on? Why are people still putting money into ETFs? Where is the ocean of money coming from? What is it going into? What challenges does it face? A lot of questions here. Let's talk with Matt Bartolini, Managing Director at State Street Global Advisors and Head of Spider Americas Research, and Troy Donahue, Head of America's Portfolio Trading at BTIG. Matt, you reported $127 billion here in July. That is a record for July, the second largest monthly inflow ever. As I mentioned, we seem to be heading for $1 trillion of inflows a year. That's a record as well. What's going on? Why is all these inflows happening?
Yeah, I mean, part of it's just the market. The market continues to move higher, and we see investors deploy cash from the sidelines. A lot of cash was built up over the years. We're starting to see investors really make a concerted effort to continue to buy into this rally. We also saw a sort of broadening of market depth, of rotation take place, and that was a signal of more risk-on vibes going into the marketplace. We saw small caps do well, cyclicals do well. Equities in general took in $78 billion. A lot of that was just the U.S. So it's just sort of a lot of concerted efforts to buy into this rally. And then fixed income added another record $38 billion. And a lot of that was driven by credits, or another risk-on type of trade going on in the ETF marketplace.
And Troy, it sure seems like Goldilocks here for ETFs. I mean, we just put up a full screen here. We've got momentum, the S&P being up about 15 or 16% this year. We've got earnings growth. We've got generally lower rates, certainly trending in that direction. We've got rotation. We've got a reasonably strong economy still. What could derail this in the second half of the year? It's kind of perfect situation.
Yeah, it's been a great start to the year. Like you said, could be the first $1 trillion year that the ETF industry has. And I think investors are kind of waiting to see what's going to go on with the election. It was a little bit more clear a month ago, and now with a few changes that have happened, investors may be hesitant to put more money into the ETF market and the stock market in general until they get a little bit more clarity on that situation.
So July, though, I just want to look back. It really was extraordinary, the great rotation that occurred here. It was a month when small and mid caps and value stocks rose, and cyclical groups like regional banks, home builders, industrial rose. These are cyclical. These groups, we haven't had big inflows in these groups in a long, long time. Did we see actually evidence that there was inflows? Was it a noticeable change? Did the big rotation actually happen in terms of inflows? 100%.
So small cap ETFs in the US took in $13 billion. That is the second most ever, and that flow is backed by returns. So if you look at small relative to large, small caps beat large caps by 10%. That is the largest differential since 2000 and the third largest overall in the last 46 years. There was a significant rotation into small caps, and investors bought into that. Same thing with cyclicals and value. Value, while had less flows than growth, the spread between those two narrowed last month, and again, that was supported by strong returns. Value outpaced growth by a significant amount. And we're starting to see this broadening of economic growth, this broadening of fundamental growth, and a broadening of sector dispersion where it's not so heliocentric towards tech.
Yeah, so we had inflows into small caps, the second largest inflows into small caps ever, 11 billion. We still had inflows into tech, which surprised me, and cyclical sectors had nice inflows. Troy, it sure looks like equities reign supreme in terms of inflows. Any thoughts here on this first 7 months and the rotation that we saw in July?
Yeah, equities have dominated the inflows year to date. So far, about $320 billion have come into equity-based products. You compare that to fixed income, which is about $155 billion in inflows. Both very big numbers, but 2 to 1 compared to equity versus fixed income. If you look at 2023, it was much more in line with each other. And I think it goes to show that investors are chasing that rally. We're setting all-time record highs, and they want to have that equity exposure in their portfolios.
What is the relationship of flows to prices, for example? I mean, it seems logical to me, having done this for 30 years, that flows will follow prices, but is that, I'm trying to figure out how much of a tell flows are. You can have prices go up and not have flows, but you can have prices go up and have flows, and then you can have very little movement in prices and flows go up. What's the you've been studying this for years? What does flows help us understand?
So it helps you understand buying behavior and investor sentiment. But ETFs, because you can short them, you can also get some wrong takeaways. Right? For instance, back during 2020, we saw massive inflows into energy. But that was because investors were buying our energy ETF and then shorting it on the secondary market, sort of a long to lend type of create activity. So you have to really look beneath the surface. But when I look back at July, we definitely see trends emerging where there are risk on, because you can start to paint this theory by looking at multiple areas that are receiving the same type of price momentum. So if we were to run a momentum score on sectors, it basically looks at technology, then financials, then utilities as 1, 2, 3. And what were the top 3 sectors getting inflows in July? It was technology, it was financials, and then utilities, which kind of seems a little bit at odds with the other 2 sectors, high growth and the cyclical.
Okay, so it makes sense though. Absent weird shorting, normally flows will follow prices. There is a relationship. Here there was, clearly, right?
There's going to be a relationship on sentiment. Sometimes you're going to have secular drivers that are going to prop up the ETF market because there's so many different use cases. We see that within international developed ex-US ETFs. They took in $4 billion in July. But when you look at it more broadly, and you look at what EM had done in single country ETFs, so China had outflows, Mexico had outflows, European-based ETFs had outflows. It was very US-centric, which I think speaks to the market rally, but also what might have transpired on the political scene in July, where you started to see the polls shift one way.
Okay, so we also saw significant inflows into fixed income ETFs. The first 7 months, as you heard Troy say, a record $156 billion in inflows. Investors love these 4% yields, guys. I mean, that is very, very sticky money. But the 10-year yield just dropped below 4% today. So we saw these ISM numbers that were a little weaker than expected. Look at these inflows here. Fixed income is still pretty strong here. So we dropped below 4% on the 10-year today. I don't know. I know you're not a prognosticator on the economic front, but might that fact reverse some of these inflows that we've seen?
So I don't think so. I think we've seen investors use fixed income ETFs for different reasons. One of them to extend on duration and sort of harness some of that duration-induced price appreciation from yields coming down and prices rising. I think that is likely to continue on to the rest of the year if we start to see yields coming down further on that tactical use case. But also, if yields are getting lower, you need investors to sort of get that coupon. And where's that going to come from in the fixed income space? It's going to be credit. We've already seen that trade materialize so far this year. And in July, credit-related sectors, investment grade, high yield, bank loans, took in around $13 billion, $50 billion on the year, which is roughly about 40% of all fixed income flows this year. So definitely biased toward credit because of that yield, because of the economy, because of growth. I think there's some tailwinds there for that to continue into the rest of the 5 months of 2024.
We also see today, I just did a story earlier, utilities are up today, real estate investment trusts are up. So, your old favorite, your Con Eds of the world, Edison, are up today. I mean, the idea here is that yields in treasuries come down, it makes it more attractive to buy utilities at this point.
Yeah, I mean, so utilities, like I said earlier, really strong inflows in July. We also saw dividend ETFs. Dividend ETFs had strong inflows in July as well, and makes that sort of relative trade. If you can't get that income out of bonds, where are you going to find that yield? Right? If you can't get the income out of treasuries, you're going to have to go somewhere else. And within the ETF industry, there's a lot of options now.
How about that, Troy? Dividend, that's not a phrase we heard much all this year. What do you have? STY is the spider dividend, right?
Yep, STY.
Any sense that might be more attractive for people in the second half of the year?
Yeah, I think investors are always looking for that yield play. There's a number of different products that offer it, and they've come to market recently with synthetic income or dividend plays. But ultimately, clients are going to want to chase that yield and have products that can provide yield to their portfolio and offset some of their other equity exposure. So a lot of our clients are coming in and using those dividend plays as sleeves of their portfolios outside of their core portfolio of ETFs.
Yeah, it's remarkable, even though the S&P 500 is what, 1.5% dividend yield, somewhere right around there. There's an awful lot of stuff that's in the 3% range, and it's not just some REITs. There's energy stocks, there's some financials that are out there right now. It's curious because, in theory, you know, the academic literature is dividends don't really matter. I mean, it just reduces the balance sheet. You're just distributing money, but you know, you're not getting free money. It's funny. Some people think that dividends are free money, and you explain to them, well, if you're reducing the balance sheet, you know, it's not. If that would be a great trick if we could do that, and ex-dividend, the stock should drop. If you're distributing 2%, you know, theoretically the stock should drop 2%. Otherwise, you really are getting free money. But people seem to love dividends. They believe in them strongly. There's a very dedicated class, I have noticed at 30 years at CNBC, that really likes getting their dividends. If you explain them it's not free money, they kind of get it intellectually, but they'd still like the distribution idea.
And now there's a new way to play if you're looking for those distributions, and those are the synthetic income ETFs. So if you want to maintain that core equity exposure, there's plenty of sponsors that are now using option overlays in order to get that yield with outside of your core equity holdings.
I want to just ask you about the upcoming presidential election. Is there any way that might be influencing chart or fund flows? For example, former President Trump, I know, obviously favors less regulation, and that could that benefit, I don't know, financial services firms or healthcare or something like that, where there might be, he might want less regulation, for example. Is there any play here, even around the presumptive Democratic nominee, Kamala Harris?
Yeah, so I mean, we obviously saw former President Trump's poll numbers move higher in July, and at the same time we saw different sort of Trump trade 2.0 effects take place, where, like I said earlier, you know, China ETFs had outflows, and of course former President Trump's very harsh on tariff policies and trade policies. We saw Mexico ETFs have outflows, basically 11% of their overall assets. Emerging markets, same thing. And then on the regulation front, financials, they would uniquely benefit. They're more service-based, but also maybe potentially less regulatory constraints that could help bolster balance in capital, balance sheets on their capital. So we saw some flows, obviously, in the financials as well. Domestically oriented industries like small cap did well as well. So I think still too early to tell, but as those poll numbers are erratic, you're going to start to see shifts in and out as the market tries to suss out where you want to be based on some fiscal policies that are coming to the market in November.
Right. Again, this is sort of a political play here, but I mean, to the extent that former President Trump relies a lot on tariffs and protectionism, that would be a negative for international investing. It would be a negative for China investing, it would seem to me, wouldn't it?
Yeah, absolutely, and we've seen that in the flows so far. I think another thing that people are looking at as his poll numbers were going up was the reflation trade or the reshoring trade. So basically bringing supply chain and processes back to the U.S., and that would ultimately favor small caps. We saw that about a month ago when there was big inflows and positive performance into the small caps, and that's because they rely on a lot of revenue from the U.S. So bringing more jobs back, more processes and supply chains back within the U.S. will help drive that.
Yeah, and yet that's a very expensive process, isn't it? I mean, globalization works because it centralized supply chains, which reduce costs and created very efficient distribution lines. If you're going to dismantle that, start building fab plants, semiconductor plants in Arizona for tens of billions of dollars, maybe it's better for national security reasons, but it's going to cost more, right? It's inflationary to do that.
Well, I mean, I think that's another thing about this election is that some of the policies on both sides of the aisle are likely to be inflationary, and I think they're also likely to extend the fiscal deficit too. And also, I think part of most people can agree upon is that this election is likely to stem some volatility. So if you take those three factors combined of like maybe potentially reflationary, extending your fiscal deficit, which is never really a good idea, then also macro volatility because of uncertainty, I think irregardless of policies, one of the plays that investors want to be considering is gold, just to manage those macro risk shocks, but also the impact of some of these policies on your fiscal deficit and inflation.
Yeah, it's not easy to figure out. We're now in month August. now. Traditionally, August is a lousy month for the stock market, and it's also a month where we traditionally see outflows in ETFs. It's one of the few months, I think, you're the expert, isn't it? Usually you get outflows in ETFs.
It's usually the weakest. We've seen outflows.
Why is that? Why?
More people are at the beach. Maybe, I don't know. I mean, that could be one reason.
It's flowing out to the ocean? Where, I mean, what happens? They sit there and they say, nah, I'm not putting any money in.
I mean, yeah, that's obviously anecdotal, but you know, part of it is there's a lot more macro risks in August. I think a lot of people don't realize that. Fundamental news stops. You don't really have as many earnings reports. And lately, Jackson Hole has been a very big market-moving event. And now this year, we're going to be sort of stuck in this macro vortex. You're going to have a lot of economic data coming out, trying to figure out what the Fed will do next. You're going to have a handful of political headlines, including the DNC. And it's going to be a lot of these macro risks. So August is presenting a little bit of a challenge to this $1 trillion mark. But so far this year, the pace that ETFs have been on have been sort of, you know, unstoppable sort of force, so to speak.
How about you? We were talking about maybe $1 trillion in inflows this year. We're 60% of the way there, it looks like. Can we do that?
I think we have a good shot at it, but I think investors are going to want to see some clarity from the election. So I think those last 2 months are going to prove to be the turning point and telling point whether we can get to 1 trillion. There's a ton of money on the sideline, like Matt pointed out earlier. I think if we continue to grind higher, people are going to race to put that money to work before the end of the year if there's no pullback.
Yeah, it's a very tricky market to call right now. This is why Jack Bogle, founder of Vanguard, a man who influenced me a lot, said, it's time in the markets, not timing the markets that matters here. You might want to just understand what your risk factor is and stay invested and stay with your plan at this point. Very tricky to go in and out of the market in these kinds of situations. Gentlemen, thank you very much for joining us. That does it for this week's ETF Edge. My thanks to Matt and Troy. We've asked Troy to stick around and give us more thoughts on where ETFs might be heading for the ETF Edge podcast. That's coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.